We analyze this moment using our strategy's five-phase framework. We track signals, not personalities or headlines. This is about sequencing risk, not predicting drama. This is not random chaos or one man's ego. This is a power transition colliding with debt and inflation, and that collision changes market risk faster than people expect. The source video argues the world order is breaking down. It frames recent U.S. actions as dominance-first strategy. We translate that claim into market-relevant signals. The argument is simple. The liberal world order no longer governs outcomes. Raw power and leverage increasingly do. This is happening because debt and inequality broke trust in the system, and when that happens, people choose disruption over stability. That shift reshapes policy and markets at the same time. Power moves matter only if financing allows them. America's position depends on dollar confidence and cheap funding. That is the real constraint behind the rhetoric. Reserve currency status is not permanent. It weakens at the margin when partners hedge their exposure. That raises funding costs slowly until it does not. This is happening because allies and rivals reduce reliance, and when that happens, the U.S. must pay more to borrow. That pressure shows up in yields before headlines change. Higher deficits and defense spending raise issuance needs. Markets demand compensation for uncertainty and duration risk. That compensation is called term premium. If term premium rises, long yields stay elevated. Even when growth slows, financing does not ease quickly. That traps credit and equity valuations. Narratives only matter when plumbing confirms. We watch treasury auctions, repo conditions, and dealer balance sheets. That is where stress becomes real. This is happening because markets need smooth funding to function, and when funding tightens, forced selling follows. Fundamentals matter less in that moment. Long-duration equities become fragile first. Narrow leadership increases system brittleness. Credit follows if refinancing stays expensive. We increase weight on dollar stress and yield pressure. We shorten reaction windows when signals align. We assume uncertainty can compress timelines. We do not trade fear or headlines. We still require confirmation across signals. We still operate in tranches, not all at once. Quick note: this is educational analysis, not financial advice. We describe risk, not instructions. Base case remains churn with rising fragility. Phase 2, risk increases if yields grind higher. Phase 3, appears only if funding breaks. If auctions remain strong, stress stays contained. If spreads widen and liquidity tightens, risk escalates. The system moves faster once plumbing fails. Watch yields, the dollar, credit spreads, and breadth. Ignore noise that does not hit those signals. Preparation beats prediction in uncertain regimes. This moment feels dramatic because leverage is high. We do not need to be early. We just cannot afford to be late.